This is Manjula, Assistant Professor, Department of Commerce from St.Josephs College of Arts and Science for Women, Osur. Today we have to see the meaning of income and expenditure account. Everyone knows that the non-trading organizations prepare receipts and payments account for recording cash and bank transactions in order to record the expenses and incomes of the concern. The concept of income and expenditure account came into existence. The income and expenditure account is the summary of all items of incomes and expenses which relate to the ongoing accounting year. It is prepared with the objective of finding out the surplus or deficit arising out of current income over current expenses. It is quite similar to the trading and profit and loss account of a trading concern and is prepared in an exact manner. Next, characteristics of income and expenditure account. Non-trading concerns prepare this account. Its nature similar to profit and loss account as made by the profit concerns. Though it is prepared at the end of the year, it does not mean that it shows a record of a whole year. It determines the surplus or deficit of income over expenditure. The concern prepares this account by strictly following the double entry system. The surplus or deficit of this account is transferred to the capital fund account. Unlike the receipt and payments account, it does not start with an opening balance and hence with the closing balance. It strictly follows the accrual basis of accounting. An independent auditor has to audit this account for the valuation of the account. Advantages of income and expenditure account. Revenue information. One of the major advantage of this account that it helps the concern to know about its revenues. It gives the concern about their past records and the current trends. Moreover, it will provide the concern relevant information for their futuristic course of action. It tells them their major sources of profits and their where they are spending a lot. It helps them to control the exaggerate expenditure approach, beneficial for the investors. Investors are very much interested in the profits and losses of the concern. In case of non-trading concern, it is especially the government which is interested in the statement of the concern. Disadvantages of income and expenditure account. Nobody can deny the fact that whenever there are advantages, there are certain disadvantages too. In the case of the income and expenditure account, there is only one major disadvantage. This disadvantage is misinterpretation of data. As we have seen above, also that the concern is highly dependent on the government for various funds and facilities. The government is only interested to help only those concerns which are performing well. The wellness of the concern is visible by its statements. In order to show their competence, it is mostly seen that they end up doing window dressing of these statements. This becomes a very major disadvantage of this account. Steps to prepare income and expenditure account include all items of receipts and expenditure on the respective side of the account. Avoid entering capital incomes and expenses. Make adjustments of prepaid and outstanding expenses and incomes. Further items included in receipts and payments account, depreciation, provisions, and profit and loss on sale of assets will have to be included in this account. Finally, after putting down all items of revenue and expenses, you will get a balance. The resulting balance will reveal the surplus or deficit. So format of income and expenditure account for the year ended. Expenditure side, we have to enter consumable materials, salary and wages, repairs, expenses, entertainment expenses, printing and stationery, newspaper and periodical, postage, all the expenses it should be incurred in the expenses side. And credit side, we have to enter all the incomes, that is subscription value, grants received, entrance fees, general donation, interest on deposits, dividends, etc. Balance of account. difference between receipts and payments account and income and expenditure account. And first one is balance of account. Receipts and payment account. The difference between receipts and payments represents the balance of cash in and or at bank or bank overdraft at the closing date. Income and expenditure account. The difference of income and expenditure represents either surplus or deficit balance. Outstanding items. Receipts and payments account, it restricts itself to cash transactions only and does not take into account any outstanding income or expenditure. Income and expenditure account, it includes all incomes whether received or not and all expenses whether paid or not relating to the period under review. Balance sheet. Receipts and payments account. A receipts and payments account need not necessarily to combine by a balance sheet. Income and expenditure account. An income and expenditure account must be accompanied by a balance sheet for the period concerned. Placing of placing of items. Receipts and payments account are shown on the debit side and payments on credit side. Income and expenditure account, it is prepared in the account for all the revenue incomes appear on the credit side and expenditure on the debit side. Carrying of balances. Receipts and payments account, the balances of receipts and payments account is carried on the next period. Income and expenditure account, the balance of income and expenditure account is not carried to the next period but is added or deducted from the accumulated debit side. Thank you.